Hello, my name is Jennifer Delgado and I will be talking about white collar crime. Susan Israel defines white collar crime as a non-violent illegal acts that are committed by individuals or businesses and government organizations for financial and personal gain. Today's definition states that white collar crime encompasses a broad spectrum of criminal behaviors for financial gain in a non-violent manner. It's mostly often committed by business people, government officials, and people in professional positions. The term white collar refers to the person's profession. This means that they may wear business attire as required by their own profession. White collar crime came into existence when Edwin Sutherland gave his presidential address to the American Sociology Society in 1939. In his talk, The White-Collar Criminal, he opposes criminology theories that blame poverty, broken homes, and disturbed personalities. He believes the opposite, saying that business lawbreakers were far from being poor, they had happy families, and were mentally sound. He published White-Collar Crime 10 years after further research. In his book, he documented crimes done by America's 70 largest private companies and 15 public utility corporations. Sutherland's definition of white-collar crime is a crime committed by a person of respectability and high social status in the course of his occupation. There are many types of white-collar crimes. A few include embezzlement, money laundering, mail fraud, and insurance fraud. Embezzlement is a conversion of someone's assets to one's own use for purposes other than what they were entrusted with. This can be done by the falsification of records, writing bad checks, or creating employees of businesses or businesses that don't exist. Money laundering is making dirty money seem like it came from a legitimate source. This is done by creating fictional loans, investing in cash incentive businesses, or transferring funds to trust and shell companies. Mail fraud uses the U.S. Postal Service to defraud people of money and property. A few ways this is done is by creating phony sweepstakes, solicitations for fake charities, and credit card offers that need to be paid for first. Israel defines insurance fraud in two different ways. The first definition is the commission of any act that is intended to fraudulently obtain a benefit to which the perpetrator is not entitled. The second definition she gives is the denial by an insurer of a benefit to which an insured is entitled. There are different types of insurance fraud. The first one is life insurance fraud. It involves faking one's death to receive life insurance benefits. Another more extreme act is murdering a family member in order to collect their life insurance money. Healthcare insurance fraud is usually done by patients, providers, and insurers. Car insurance fraud involves criminals that stage collisions and, with the help of a doctor, submits claims for personal injuries. If there were to be a real accident, the driver can exaggerate the damage by including past sustained damages or exaggerating the injuries. The last type of insurance fraud is property insurance fraud. This happens by overstating the value of property that's lost or damaged. It can be either in a flood or by fire. The Sarbanes-Oxley Act of 2002 was intended to curb white-collar crime. Congress passed it in response to business scandals such as Enron and WorldCom. It makes it illegal for registered public accounting firms to provide non-audit services to an audit client. Under the Sarbanes-Oxley, willfully failing to maintain proper records of audits and work papers for at least 5 years is a felony. The punishment is up to 10 years of imprisonment. Another felony is the destruction of documents that are involved in a federal bankruptcy investigation. The sentence for this is up to 20 years of imprisonment. Under Section 201 of the Sarbanes-Oxley Act, the following are illegal: bookkeeping or other services related to the accounting records or financial statements of the audit client, financial information systems design and implementation, appraisal or valuation services, fairness opinions and contribution in kind reports, actuarial services, internal audit outsourcing services, management functions or human resources, broker or dealer, investment advisor or investment banking services, legal services and expert services unrelated to the audit, and any other service that the board determines by regulation is impermissible. The reasons behind white-collar crimes are simple. Many people justify their behavior to help them believe that what they're doing isn't wrong. Another reason is how much opportunity that person has. Another thing is greed. A person might want more money than what they already have. People might also take advantage and do it for many years if the chances of being caught are slim. For the first case, we have Neri Cohen. Neri Cohen, who was 53 at the time of the crime, served as a consultant and Medicare biller for Greater Miami Behavioral Health Care Center, Inc. They provide intensive treatment for severe mental illness. Cohen directed the payments of kickbacks to patient brokers in exchange for Medicare beneficiary referrals. She received a percentage of the Medicare reimbursement from Greater Miami's PHP as compensation. She concealed kickback payments to shell companies owned by patient brokers with the help of Dean Butler and Irina Mora. They disguised them as outreach or marketing payments through H&B Shell Care Inc., which was a sham staffing company. Court documents show that from 2006 to 2014, Greater Miami billed Medicare approximately $63 million for alleged mental health services. U.S. District Judge Beth Bloom sentenced Butler and Mora for 16 years and 9 years in prison, respectively. For the second case, we have Troy L. Seesum. Troy L. Seesum, who was 53 and lived in Greenwood, Indiana, was sentenced to 41 months in federal prison for stealing more than $2.7 million from an Indianapolis construction company through fake invoices. He started working as a project manager for F.A. Wilhelm Construction Co. Inc. in Marion County in 2000. His job was to oversee construction projects, which included worker management, material delivery at job sites, and cost estimates as well. He started stealing from Wilhelm about 3 years into his work. He created a fictional company called LTEE Source. He wrote fake invoices for construction material from his fictional company, which then billed Wilhelm. He used Wilhelm's accounting system to approve invoices, and he often hand-delivered them to the accounting department. The checks to LTE source were then sent to a commercial UPS mailbox registered to LTE source, but the mailbox was actually owned and maintained by CSUM. The checks were also being deposited into LTE source bank accounts, which were held under CSUM's wife's name as well as his own. CSUM and his wife used the money to write new checks to himself, which he later signed with the fake name Lee Little. Court documents show that he used the money to pay off credit card debt. He submitted 185 false invoices and embezzled more than $2.7 million from 2003 to 2015. In 2010 and 2014, he didn't report income from his thefts, and the total loss from the IRS was more than $381,000. CSUM must serve 2 years of supervised release following his sentence, according to Assistant U.S. Attorney James M. Warden, who prosecuted the case for the government. He will also have to make full restitution to Wilhelm Construction, as well as pay the entire tax liability to the government. The last case we have involves Wells Fargo. Wells Fargo employees were secretly creating millions of unauthorized bank and credit card accounts without their customers knowing since 2011. The fake accounts earned the bank unwarranted fees and allowed Wells Fargo employees to boost their sales figures as well as make more money. Wells Fargo confirmed to CNN Money that they had fired 5,300 employees over the last few years related to this behavior. It states that Wells Fargo employees went as far as to mistake. Wells Fargo employees submitted applications for 565,443 credit card accounts without their customers' knowledge or consent. About 14,000 of those accounts incurred over $400,000 in fees. That included annual fees and interest charges and overdraft protection fees. Wells Fargo agreed to pay $185 million in fines, along with $5 million to refund customers. Of the total fines, $100 million will go toward the CFPB's Civil Penalty Fund, $35 million will go to the Office of the Controller of the Currency, and the other $50 million will be paid to the City and County of Los Angeles. That is all I have for today, and thank you for watching.